Hi, Dr. Cook.
Reaching for the mute button. Good afternoon. Good afternoon. How's everyone doing today?
I've told the guys I'm staying off. I know we're live already. I can't be on camera right now.
It's all good.
It's been a rough day.
At least for, I think most Mary Kate, it's a 3-day weekend starting tomorrow. So hopefully there's a little respite for everybody.
Oh, that's right. I forgot. Norman's going to be on, right, John?
That's my understanding. Nanette
Okay.
is actually traveling, so that's why I've got Dom running it. Dom, thank you. But I'm pretty sure we'll give him a couple minutes, Mary Kate, and then if not, Matt, good to see you. We'll Mary Kate, I think we can just move it along then.
Yeah, absolutely.
Okay.
When I was trying to make plans, even though she's out of town.
Tony, thanks for being here. Good to see you. Appreciate it as always.
Thank you. Good to see you.
Are you able to ping him, John, just to double check? Because I don't mind having me.
I'll do that. And if you want to get us started, Mary Kate, we can.
Yeah,
do that.
absolutely.
Yeah, okay.
Yeah, I can do that. Good evening, everyone. Mary Kate speaking. I'm going to have to remain off camera. It's been a rough day. So let's call to order the Springfield Technical Community College Investment Subcommittee meeting. Don, would you please call to order the meeting of Thursday, November 10th, 2022?
Sure. Mary Kate Murin.
Present.
Norman Roldan. Yep.
Okay. Great. So I think Dr. Cook, I think we're going right into fiduciary governance calendar with the team.
Yeah, and just by orientation, I know we've got Mike Chase on the phone. Mike, appreciate that. Matt Frantini from Fiducian. Is it Matt? Do you want to do the calendar piece, or is it John and Andrea that we need to discuss that?
Go ahead.
Yep, I was just going to say that Matt, I think Matt and Mike would be covering that part in their presentation.
Oh, good. Okay. All right, Matt, we'll leave it in your hands. Thank you.
Perfect. I'm just going to share my screen now. Does everyone see my screen now?
We do.
Perfect. Just before we get into everything, and good evening, everyone. Just want to make sure everyone has been getting our collateral and thought pieces around the firm and our different business lines. We've been putting out a lot of good information on the endowment and foundation space. So if you're not receiving that currently, please let us know and we can update our records accordingly. And as we look at the fiduciary governance calendar for this quarter, the focus is governance in itself. And the two main topics we'll be looking at is the investment policy statement and also committee best practices. When we look at your current investment policy statement, we do not believe there's any need to change it at this current time, and we think it's in a good working order. It contains all the necessary pieces that we think it should contain. You might see some X's here or NAs. That's nothing to be alarmed about. For example, the liquidity guidelines X here, that generally comes into play for a lot of our clients if they have, for say, illiquid investments with private equity and they need to stay within certain thresholds. The same can be said for ESG considerations if our client is heavily invested with environmental, social, and governance considerations. They have dedicated language within their policy. So how the investment policy statement stands today, no concerns on our end. And then just looking at committee best practices, we believe that this committee currently follows these practices and there's no areas for concern on our end. As you can see, having a disciplined thought, meeting regularly, really have a diversity of thought as well, using experts in the field and also asking questions and challenging questions along the way, which this committee does. So those are all positives. And then just also bringing it back full circle to what I started off with, here's some just pieces that we've come out in the recent quarter on the markets, some of our webcasts, newsletters, and podcasts as well. Any questions on the governance calendar before we jump into the capital markets?
No, I don't. Thank you so much, Matt.
Perfect. So as everyone is aware, just by watching the news and probably just reading the headlines, it's been a very challenging time so far this year in the capital markets. That's really been led in our eyes by three major factors. The first being in the upper right-hand corner here is the Federal Reserve and their interest rate raising campaign. So you can see here, looking at this light blue line here where it's labeled 2022, this is their current campaign that they're on now. And it's really the fastest and most aggressive campaign that we've seen to date. And it's really been to really drive out inflation that we've seen in the market. But the main headwind that they're facing right now in doing this is the strong labor market. So it would be a lot easier for them if we didn't have such a strong employment. We did see a very kind of positive print today in the right direction. We did see it come down substantially in the right direction compared to the last couple prints we've seen, and the market reacted. So you saw the S&P 500 today up over 5%, and the small cap index over 6%. But it has not come without some pain, and everyone has seen that pain so far year to date with the inflation. Looking in the lower left-hand corner, this is just looking at the dollar strength versus other major currencies around the world. And it is really quite remarkable how strong the dollar has gotten versus these four other currencies. Looking at the euro, the pound, the yen, and the renminbi. This is starting in December, so basically almost 3 quarters worth, and you can see just how relative strength it is maintained. So this is really negatively impacting any dollar-denominated investor investing overseas. So if you're thinking international stocks, international bonds, it's been a really big headwind for domestic investors. And then just rounding off my comments on this page is looking at the PMI manufacturing index here. So anything below 50 represents an economy that's contracting. Anything above 50 shows expansion. So you can see the United States is currently the only economy that is in a technical definition of expansion, while the other major economies around the world are starting in a contractionary phase. So that's really driven by global supply chain, COVID zero policy in China, and also logistics. So that has also played a major role in the capital markets so far this year. I mentioned earlier the labor market, and as you can see here on the graph upper left-hand side on page 19, we're back to the pre-pandemic lows for unemployment. So it's really quite remarkable, and that's just one of the major headwinds that the Federal Reserve is facing in this campaign that they're on right now. And that really ties into this graph, lower right-hand side of the page, the US inflation numbers. So this graph is represented through August. So we've had 2 prints since then. The print in September was stronger than what we saw in August, but then we had the print today, which came out with 7.7% for the CPI, and core was down to 6.3. So the headline number did come down, which is in the positive direction. We just hope to continually to see this number decrease over time. So that just shows that through this pain in the Federal Reserve raising rates, there has been some benefits, hopefully. Now looking at the markets in general, left-hand side of the page is the fixed income markets. Center of the page with the gray bars is the equity markets. Right-hand side of the page, light blue, is real assets and also hedge funds. If we look on the left-hand side of the page here, the bar chart is the year-to-date number. The circle is the quarter. So you can look here at the core bond index, third bar in from the left. From a year-to-date standpoint, down 14.6%. It really jumps off the page. We're on track for the worst year ever for the Bloomberg Barclays Aggregate Bond Index. And that's primarily driven just by how drastically interest rates have risen. So if we think of rates rising, bond prices are coming down, inverse relationship there. When we look at the equity markets, you can see from a year-to-date standpoint, both large cap and small cap have really moved in tandem, down approximately 25% each. We did see small cap, though, for the third quarter perform better than large cap, down about 2%. Looking at the international markets, similar story from a year-to-date basis, down about 27% each, respectively. But when you look at the quarter, you can see some discrepancy there. International developed was down 9%, while emerging market was down 11.6%. Something that's interesting with these returns is the relative strength of the dollar, as I mentioned earlier, and we'll show you in about a slide or two, just the magnitude of the performance when we bring this back into dollars, how drastic it really is. And then just the one outlier on this page is commodities, and you can see from a year-to-date standpoint, up 13.6. So this is really, when you look at it, your oil stocks is the sole outlier for the year-to-date basis being positive. When I was talking about the international stocks and markets, as an example, you see here through a year-to-date, the UK is down 18.7 in dollar denominated terms. But when we look in their local currency, they're only down 1.5%. So that just shows how strong the dollar is affecting returns. But in their local currency, international markets have really outperformed domestic markets. There's no questions on that. We can jump right into the portfolio, and then just a quick update on the markets as well through October, or actually through last night's close as well.
More just feedback, Matt. This is what I think Fiducian does so well. You always set the table really, really effectively. And even just seeing the steepness of the Fed hikes in relation to what they've done in the past is pretty eye-opening. I mean, map that again to the relationship to inflation in the dollar. I mean, here's where we are, but it's really helpful to have these foundational points. Thank you.
Perfect. Just looking at this slide quickly, two changes that we did make in the portfolio since we last had our meeting. In the long-term portfolio, we'll discuss this when we get to the manager section. We did make a manager termination with the small cap value manager. We decided to terminate Boston Partners and reinvest those proceeds with Hotchkiss and Wiley. And then also within the short-term portfolio, it was really a good play and has really benefited the portfolio a lot in the last 2 months that it's been in the program, was to jettison away from Vanguard short-term bond index and replace it with the Baird Ultra Short Bond Fund. We'll go into more detail with that as well. So looking at, it's one page ahead, looking at the long-term portfolio, these results are through 9/30. You can see that the portfolio finished off the month at approximately 19,240,000. well within line from a target asset allocation perspective. We did have a slight overweight to fixed income by about 2%. Similarly, with our hedge fund position, Ironwood, about 1.3% overweight as well. But we did see a strong rally in the month of October within equities, and we continue to see that in the first week of November as well. So we think these targets have really come back more in line since 9:30 as well. Just as an example, the S&P through last night's close in the last 5 weeks is up close to 5%. Russell 2000 is up 6%. And the one outlier is continuing to be the bond market, and it is down 1.4% so far quarter to date. Those do not take into account today's strong rally. So those numbers will be considerably higher after tomorrow. And then just from a performance standpoint, I'm on page 31, looking at the upper third of the page. You can see for the quarter, the portfolio is down 6.1%, slightly behind the benchmark, which was down 5.9%. But when we go out to later timeframes, you can see that the portfolio is either in line or ahead of benchmark across all timeframes. For example, looking at the year-to-date number, portfolio is down 19.7%, outperforming the benchmark on a relative basis by about 1.2%. Similar story on the 1 year and the 3 year as well. 3 years up 2.3%, outperforming the benchmark by about 70 basis points there. So nice relative outperformance as well, and really trying to pick up and protect on the down market that we've seen so far year to date. When we look at the manager starting on page 33, you can see here, looking at the composite fixed income line, that is the line that is shaded here. On a year-to-date basis, the portfolio is down 13.7%, while the index was down 14.6%. Similar story in numbers on the 1 year. So really, where did this outperformance come from? It's primarily, all of it is from the BlackRock Strategic Income Opportunities Fund. Your unconstrained bond manager has really performed quite well in this raising rate environment. When we think about them, they have a very low duration profile, very low interest rate sensitivity. So this has really been a great play in the portfolio. So it's really worked out to your benefit. Since we printed out this book, though, you'll see that the maintain status listed here, it's actually changed internally. We have moved this manager to discuss. One of their portfolio managers last week, Bob Miller, announced his retirement. He's going to retire at the end of March 2023. So due to this, we've decided to move the strategy from maintain to discuss. They do use a team strategy on the portfolio management team at BlackRock. So we're really comfortable with the approach and also the length of time that they've given us. And what is really makes us really comfortable with the strategy is Rick Reeder, who is the architect of the strategy, is maintaining on it as well. They're going to bring up one of the analysts to replace him on the team. So we are just going to monitor the situation, but we do have a lot of confidence in them over the long term. Looking at Brandywine, your global bond manager, you can see over the last year, they have struggled, about 2 percentage points behind the benchmark for the quarter. Similar story for the year to date and also the 1 year. This is really due to the strength of the dollar, as I mentioned earlier. It's been a big headwind for global bond investors around the world. Looking at the domestic equity section of the portfolio, in line with benchmark for the quarter, and some nice outperformance for both the year to date and also the 1 year number, up about 1 percentage point versus the benchmark on the 1 year. Diamond Hill is the first manager listed on this page here. It's the all cap value strategy. You can see, looking at their peer group ranking here, it's top decile across all timeframes, except for the 1 year. So over this course of the last year, they did struggle a little bit, and that's just due to the market environment that we've been in. So currently they do not own utilities and energy. Both of those sectors have performed extremely well. So that is what their headwind has been, but near-term results and longer-term results are really as good as you can possibly get within their universe of managers, being top decile. Still very comfortable with their strategy and philosophy. Both the large cap and also mid cap area of this portfolio is indexed. So both the Fidelity 500 and Fidelity mid cap index is tracking the index appropriately. No concern there. Boston Partners is the manager that we terminated in October. You can see here where it says watch. This was one of the main reasons that we decided to leave the manager. Similar story about a retirement, but it was very abrupt. Their main portfolio manager for the last 30 years, David DeBora, announced his retirement suddenly after not being able to reach an agreement with his other portfolio managers, and retired that day. He decided to start a family office and manage his own personal money. So given that abruptness and lack of transparency around the process, we decided to just move away from the strategy and invest those proceeds, approximately $500,000, with Hotchkiss and Wiley, another small cap value manager. Very good team process as well, very strong results and a great track record. Small cap growth manager is Conestoga. Once again, very strong long-term numbers. Some weakness on the quarter though. You can see down 4.2%, while the market and the index was just slightly positive, up 20 basis points. Conestoga runs a very concentrated portfolio, and their results were due to their overweight in technology and also no holdings in financials. So they really were on the wrong side of the dynamic here for the third quarter. But when you look at their since inception numbers, so this is when you began investing with them, which was January in 2021, you can see they're 4 percentage points ahead of the benchmark. So really strong relative long-term performance number while they've been in your portfolio. And then just rounding off my comments for international equity, both MFS and on the next page I'll show you is Dodge & Cox. Very strong performance for the portfolio. MFS has been a top decile or quartile manager across all time frames. And you can see here, similar story with Dodge & Cox, very strong performance here. Hartford Schroeder's has been a good manager in the portfolio, been right around the benchmark. They have struggled this last year though. It's really shown because of the COVID policy. They've been overweight China for the last year. They're starting to pull that back now, but it's really hurt their near-term results in the technology plays as well within China. Just looking at real assets quickly, it's been a nice play within the portfolio over the last couple of years. As you can see here, between the Cohen and Steers Global Realty Fund and also the Principal Diversified Real Assets, which was both added in 2019 and 2020. It's really protected in this market in this last year. Although those numbers are negative on an absolute basis, when you compare that versus the equity allocation, it has protected in this environment. And then the one area of the portfolio that has been positive so far on a year-to-date basis is Ironwood International, your hedge fund manager. Very nice performance on an absolute basis in this market and also on a relative basis versus their benchmark. So they've been in the portfolio just about 1 year right now. They incepted last November. So you can see here about 7 percentage points ahead of their benchmark. So really nice performance on an absolute and relative basis, given the environment that we're in. Before we go to the short-term portfolio, any questions about the long-term portfolio?
No questions, Matt, but just thank you for such a detailed example. It's really important and so you're appreciated.
Perfect. I'm now on page 44, if anyone doesn't have it up on their screen. Looking at the short-term portfolio, upper left-hand side of the page here, it gives a nice graphical representation of performance. And you can see here for the quarter, the portfolio was down about 20 basis points versus their benchmark, which was down 1.2%. So about 1 percentage point of outperformance on a relative basis. Similar story when you look to later timeframes on a year-to-date and 1 year. The 1 year, the portfolio was down 2.8% versus the benchmark, which was down 4.4%. So really able to protect in this down environment for fixed income. Then we go out to the 5 and 7 year, you can see in line with the benchmark, up about 0.8 or 80 basis points. What does that mean in dollar terms? From the quarter standpoint, portfolio finished off the month of September at $5,738,000. And then within this portfolio, we also made a change, as I mentioned earlier. We jettisoned the Vanguard short-term bond index, and we replaced it with the Baird Ultra Short Bond Fund here. After doing some research on both of the funds, we're actually able to bring down the duration for that segment of the portfolio about 2 full years and really match the yield profile. So we reduce the interest rate risk with bringing a very nice yield profile as well. So that was a very nice play for this portfolio and has worked out nicely in this raising rate environment. We can look at the managers here. Everything is in line as well. No concerns with the short-term managers. They're all on maintain. And that is your performance overview. I know we had some other areas that we wanted to discuss, so we can jump right into that. I think John was going to bring that up.
Yep, I'd be glad to. All right. Is everyone able to see this asset allocation slide? Okay.
Yes.
So, okay, great. We wanted to share at Ways and Means, we had a conversation about our cash flow position, and we currently have a healthy cash flow position. We have about $12.6 million in our operating account, and we wanted to take advantage of that position and maximize our returns. Right now, basically, it's offsetting bank fees there, but we, in conversation with Fiducian, we think we can do much better than that. So walking through this slide, we have the operating cash balance here of the 10.9 million. That is our projected cash balance at the end of this fiscal year. So 12.6 today, 10.9 by the end of the fiscal year. What we're proposing is that we would be withdrawing $6 million from the operating account, which would leave us with a balance of almost $5 million at the end of the fiscal year. And just a point of clarity, our balance is 12.6 million. It's just a steady decline until the end of the year. So there aren't any significant changes in the position. So we'll be in a comfortable position if we were to make this transfer. So that brings us to the 4.9 million at the end of the year. We would allocate that $6 million to 2 million to the short-term account highlighted over here in yellow and 4 million into the long-term account. Currently in the short-term account, as we just kind of reviewed, we have $5.7 million as of the end of September. We add our $2 million, that brings us to $7.7 million. One reason why we wanted to invest 2 million here is because we know on the horizon, we're going to need to dip into reserves for our ship's relocation, transferring $6 million for that project. And as a note, we're currently anticipating a split with 3 million in FY24 and FY25. But this shows that we would have the funds needed for that transfer. We would end up with $1.7 million available in our short-term account. Over on the long-term side, that's where the $4 million would go. So that would be increasing our current balance of $19.2 million, bringing us to 23.2. In discussion with Fiducian, we recognize that this is an attractive entry point, considering the current status of the market. We're anticipating an 8% annualized return, and that's over a 20-year period. So again, really being able to take advantage of our current cash position. Another point that I would like to call out is back up in our operating cash. So we have $5 million projected for the end of the year. As a note, in our budget projection, our plan is to use $3 million from reserves to balance the budget. This is showing that we would have that cash balance to support that budget without the need to divest from investments. So this leaves us in a relatively healthy position from all accounts, from our operating cash as well as our short-term investments if other needs were to arise, and also being able to take advantage of the attractive entry points. Are there any questions, concerns, comments?
No questions or concerns, but does there need to be a recommendation, John, to Ways and Means coming out of this committee?
We would be presenting this at Ways and Means. There doesn't need to be a formal motion, but we wanted to start presenting this with the investment subcommittee to see if there was any additional comments or considerations, and then we would move forward and have a similar conversation with Ways and Means to bring them up to speed as well.
Great, thank you.
You're welcome.
John, so, and I'm learning a lot of this stuff about the stock, but explain to me, why are we the short term? We seem to be hitting hard on our short term investment. Explain to me where we're putting that much into that. Repeat it again. I think I missed what you said earlier.
Yeah, absolutely. It gives us the opportunity. So we have the 5.7. We wanted to add the 2 to bring us to that $7.7 million balance. We are going to have the need, we recognize that the board has already approved the need to use reserves to help fund our ships relocation project. So in the matter of a couple of years, we're going to need to withdraw $6 million, and it would come from that account. So we would need to withdraw $6 million to help fund that relocation. That would then leave our short-term investments down to about 1.7 million. We still like to have some funds available for a rainy day, if you will. So if there are other investment needs, other capital needs, other projects on campus, we would still have funds available. We could always turn to the long-term account if needed, but depending on what the market conditions are, it might not be an opportune time to withdraw funds from the long-term portfolio.
Okay. Okay. Now you answered my question. Thank you.
Good. You're welcome.
And Norman and Mary Kate, let me have at the risk of repeating John, I appreciate that. Obviously, Norman, we've got a few things going on here. One is, again, we're sitting on a lot of cash. And with the market being what it is, administratively, and again, Mary Kate, within existing parameters, we can move this ahead and essentially invest it, Norm, and really benefit from what we hope to be our favorable market conditions. So let's make a little bit of money on the cash that we have. And that's why we're going to do this drawdown. What it does leave, by the way, is still a very healthy cash balance. So I'll come back to that. So that's nice. And again, in investments, we've got a short-term approach and a long-term approach. Obviously, short-term is much more conservative. It's not going to earn us as much. And that's why we see how we've divvied up the amount. And we're going to put it in these 2 buckets, essentially. But going back to that cash balance, after we invest some of this cash, I think, John, let me just check. It's 4 million, right? I think you may have mentioned 3, but it's 4 million that trustees have approved to help ensure we have a balanced budget this year. Norm, if we needed to pull all of that, we still have it in cash. So it protects our investment. We don't actually have to divest from these investment positions to get the dollars to plug the hole in our budget. So we really, I think, are in a real sturdy position. Andrea and John, how'd I do?
Yeah, I think actually the 4 million is already netted out of the 10.9 million. So the 3 million is really for next year. So it's really looking 2 years ahead. So it's actually stronger than how it looks. John, is that
even better?
Yeah.
Perfect. Yep.
Thanks, guys.
And again, logistically, we'll put this in front of Ways and Means. And again, not necessarily looking for a vote, Mary Kate or Norm, on the approach. Administratively, we're handling it, but we definitely want to be sure that you have open eyes on the approach, see what questions you may have. And again, if there's any clarification we need to do on that.
Great, thank you.
Okay.
So I think we're going right into portfolio manager review. Is that right, Dr. Cook with Mike?
I think we went through all that. Dom, if you want to bring the agenda back up, I think we're well through it all. I just want to double check on that agenda. So John, if you pull that down, Dom, then you can put the agenda back up.
Yeah, you're right, Dr. Cook.
Yep,
We did go
okay.
through it. Just
Yep.
old business and new business.
Yeah, I think we're there.
So Norm, I don't think there was any old business, if memory serves, from last meeting.
I agree too.
New business, really good to hear that we'll present on Monday to a lot of this to Ways and Means, and get their insight on the transfer of money. Is there any new business?
No, I'll just, again, Matt, Frantine, thank you. Mike Chase, I know you're listening. Thank you as always for the tremendous sturdy outlook and the help with management of all of this. It's great to see again the fundamentals are holding for us. Andrea and John Tudrin, thank you as always. Dorothy, much appreciated.
Absolutely.
So I'll make motion to adjourn. I guess that's be me, right? So we could adjourn the meeting, guys.
Great.
Good job, guys. Thank you.
Thank you so much, everybody. Have a good night.
Everybody.
Thanks,
Great.
everyone. Take care.